Good afternoon, everyone. My name is Niju Tay. I'm the head of international at KTN and also project director of Global Alliance Africa. Today, I would love to invite you to our first of 3 fireside chats on innovation investment in Africa. Today, we'll be focusing on Nigeria. But before we move on to the main panel, I'd like to talk to you a little bit about KTN and what Global Alliance Africa is about. At KTN, our vision is about establishing a network of innovators and investors around the world that the ideas is so powerful, it'll change the society around the world. And this is very much the DNA of KTN and where Global Alliance Africa program is. Now, Global Alliance Africa is a co-investment between the UK, two of the UK's government departments and our National Innovation Agency. It presents KTN with the opportunity to work in true partnership with Kenya, South Africa, and Nigeria on building stronger innovation ecosystems in the countries with greater effectiveness in commercialization, in innovation, investment, in funding, in also stronger policy governance and more effective business environment for local innovation to thrive in the future. Now, why is that important to us? Because we believe that this success will help us and our partner countries to really create higher value jobs in the future, to help promote inclusive growth and reduce poverty in the countries. And this, we believe, will change the life of civil society and shape the future development in Africa. And today, I'm delighted to be opening this session on spotlighting the investment community and opportunities in Nigeria. We're working in true partnership with CC Hub in this event. And the moderator that we have today will be Victoria from CC Hub. And Victoria will take over from this point and help take us on this journey to help us understand the opportunities of the investment community in Nigeria. So with that, I'll hand over to Victoria.
Thank you, Niju. Hi, my name is Victoria Fabumi. I lead investments at CC Hub. Today, we'll be talking about the investment climate here in Nigeria, but we'll be pulling some of our experiences from across the continent. I have with me 3 seasoned investors, particularly focused on early stage investing here in Nigeria and across Africa. Without much ado, I will do a brief introduction about them. Most people know about them, but I'll make it formal. I have Maya with me. Maya Hogan Famudu is a Nigerian-American entrepreneur. She's a founder and partner at Ingressive Capital. We have Egosa Mogui. He's founder and managing partner at Echo VC. Before Echo VC, he was at Intel for nearly 10 years. And he's invested across Africa. And I have E Aboyeji, and he is the founder and former CEO of HOF portfolio company Flutterwave, and current founder of Future Africa. So we have these 3 amazing investors, and we'll be focusing on early stage investing here in Nigeria and drawing our experiences from other African countries. You're welcome, E. You're welcome, Maya. You're welcome, Egosa.
Thank you.
Thank you.
So before we jump into it, a little bit of housekeeping. The session is a 45-minute session. We'll be breaking it down into 2 sessions, initial 30 minutes for the chat, and then the other 15 minutes will be for question and answers, so Q&A. So if you have any questions as we're conversing, feel free to ask. And once we're done, the panelists will address you. So what we wanted to discuss several things, but we wanted to discuss critical things that affect the Nigerian ecosystem. And please feel free to, perhaps as we have this conversation, highlight other areas that we haven't thought about. As early investors, I know one of the important things we think about is our investment vehicle. Perhaps I'll start with E. E, what's been your experience in terms of setting up investment vehicle either here in Nigeria or across the continent?
Yeah, thank you very much for having me here. It's a fantastic initiative. My background really is on kind of both sides of the table, which is rather unique in our ecosystem because most people come into the field mostly from a finance background or from a prior investment background. But I helped build Andela, and I helped build Flutterwave, and I helped also angel invest in tons of companies. So I bring that perspective to the table when we talk about kind of the challenges and opportunities with fund formation. I've also done a Nigerian fund as well as Mauritius fund, as well as a US fund. So there are particular differences between all of them. But I think that the key kind of differentiating experience really comes from three elements. The first is the depth of the capital markets within the country. The two is the ease of regulatory, I would like to say arbitrage between the countries. And then the third is, the sophistication of the instruments that are available, given the range of the legal professionals within the country. And comparing between the experience, there's so much work we have to do in Africa, particularly in Nigeria, with respect to deepening those three. The capital markets are not deep enough, even though the market is there and is available. It was only last year, after over 30 years of banking in the country, that banks were finally allowed to officially, by law, invest in venture capital funds up to 10% of their assets. So these type of legal changes and progress is extremely important for deepening the capital pool. With respect to instruments, there are challenges with safe instruments, there are challenges with standard equity agreements, standard convertible debt agreements that haven't yet been ironed out by our legal community. There are challenges around redomiciliation, especially given that because of the depth of capital problem, a lot of our companies are having to domicile their parent companies in the US. And so that contributes to the need for redomiciliation and ensuring that the two jurisdictions are playing nice with respect to taxes and IP exchange. And that's another challenge. And then finally, just the sophistication of the capital pool. In our own respect, what we've tried to do is actually push the limits in all these respects in Nigeria. Unfortunately, we couldn't necessarily do all of it from Nigeria, but we've kind of spread out between all these different jurisdictions. So in the US, we run the country's first rolling fund, where every quarter investors can commit capital, up to 99 investors can commit capital. And we can invest their capital and give them kind of an index-like exposure to startups. We've also been able to make the syndicate model work very well together with our partners at AngelList, making it possible for accredited investors to be able to invest small sums of money in large groups without impacting the founders' cap table. So these are some of the things, but I think there's a lot more ways to go with respect to the venture capital and particularly the private capital markets on the continent.
So if I understand you clearly, it means there's still some work to be done before we begin to see investors like yourself look to domicile their fund here in Nigeria.
Not necessarily. I would say we are here to do the work. So we're committed to the region, whether the work is done immediately or not. I mean, we're in the process. We just in the process of registering as a advisor, and we're taking a look at the crowdfunding license as well, together with partners. We just started a partnership around a trust business in Nigeria with a number of banks and asset managers. So there is, we're going to do the work. It doesn't matter whether the country is ready or not. We have a track record of pulling the country towards the bleeding edge of innovation with Andela, with Flutterwave. So I'm not going to wait for the country to be ready. We'll drag everybody there kicking and screaming, and then we'll get our flowers later.
Amen.
I was going to come to you, Maya. I was going to ask, so what has been your experience in terms of the investment vehicle and its domiciliation and just deploying capital from Nigeria?
Yeah, I think he laid out a lot of the really important fundamental points. And just to add on to that, so we are Delaware Incorporated LLC LP, because we also have to take into consideration the types of investors that have the risk appetite to be investing across sub-Saharan Africa. And it's not exclusive to Nigerian investors who are used to the Nigerian regulation and the entity structure and like the taxation, et cetera, et cetera. So on the limited partner level, both the institutionals and HNIs, like we have sovereign entity capital in our fund, and there are certain jurisdictions that they can't invest in. So we have to be considerate of where we're locating the entity for the sovereign and institutional capital that sort of the US likes to overtax. And then we also have to be cognizant of the Western investors who are actually deploying the majority of capital into early stage technology companies across Africa, and sort of double taxation treaties and who does or does not have them, because we don't want to expose our limited partners to any sort of additional and undue tax burdens. So that's what we're considerate of on the limited partner level. And then as far as on the actual company level, as E mentioned, a lot of tech companies that are based on the continent do have parent companies in Delaware that are with wholly owned subsidiaries based on the continent. And that's what we actually ask our companies to do as well, because of the flow of capital when those liquidity events happen, where we anticipate. So one, the actual payouts, and again, the tax component of that, but also just considering, yes, the regulation, the enforcement of intellectual property rights. If there is some sort of trouble with the business, in what jurisdiction can we ensure that there's going to be a case heard within 30, 60, 90 days? We can sort of reach a resolution and move on, and it's not something we're dragging out for the next 10 years, which we know can happen in the Nigerian market. And then, yeah, the last thing to just drill down on is in addition to underdeveloped capital markets domestically in the other African nations where we're actively investing, considering the different types of liquidity events. We know that the majority of liquidity events on the continent are currently happening through M&A activity. And a lot of that is international firms acquiring local assets as market entry strategies. A lot in 2020, we saw the same. And so we have to be structuring our entities in ways that are attractive to the acquirers that are actively participating in the market, as well as the investors that, the early stage investors like us may be able to exit through secondary share sales. And so in anticipation of, yes, of course, our local markets are going to continue developing. And I strongly believe that in the next 5 to 10 years, the tech companies that we're seeding today will be key contributors to GDP in the target economies where we're investing. But as we're waiting for that maturity to happen, we are looking to and increasingly seeing African businesses listing on the London Stock Exchange, on the New York Stock Exchange, the Toronto Stock Exchange. And I'm getting a lot of inbound requests from various international exchanges, whether it's like their AIM program, so like the earlier stage, public listing, or the secondary markets, or what have you, or actually discussing the potential of African startups listing formally on these traditional stock exchanges. And so, in consideration of that liquidity events as well as the M&A, we do have to structure things in the meantime so that we can ensure we can get all the money that is out there for African tech.
Absolutely, I understand. So this brings me to the question I was going to ask Agosa. In light of some of these things that Maya and E have mentioned, we will all agree that the market is maturing. It's growing. It's not mature, but it's better than it was 5 years ago. The changes that have occurred in the market, or the evolution we've seen in the Nigerian market, would it compel you to want to have some sort of structure or vehicle here to support early stage investing? What do you think in light of the evolution in the market?
So I think it's very investor driven, okay, right? So there are US investors we know that use Cayman Islands entities to invest. Mm-hmm. And they've always done that and will continue to do that. They don't use US, so they have some vehicle that's domiciled in the US, but the actual activity gets done out of, the Cayman Islands or Mauritius or the like, depending on whether they're looking at Africa or Asia. And we've also seen them use Cayman Islands entities to invest in American domiciled companies. So the truth of the matter is that, each investing fund will take the most tax efficient path for the specific thesis that they're pursuing. So for instance, if you're a real estate fund, it is a different way you would do it versus if you were just doing credit. The different strategies, different investment strategies will require some different approaches. The more important question though is the local ecosystem evolved enough for you to be able to do all the things that you have to do as a fund manager, right? So one of the things that you're going to be able to do is you have to constantly go seek investors, and investors can be broadly diverse, on geography, based on geography. And so if you're saying, listen, I want to go seek investors and I have a mix of both local and international investors in a Nigerian vehicle, the first thing you're going to want to figure out very quickly is we say this internally in our firm, as a fund manager, you raise, you deploy, you return. And so when you raise, the money comes in. How's the money getting treated? Okay, then you deploy, and then how does that money get treated? And then you return, how does that money get repatriated? And so, of course, when you're so excited at the beginning trying to just raise capital, you may not necessarily think through the entire timeline. But then once you now get into, oh, I have a small exit, I need to get the money out, and then it becomes this whole issue of I can't get the money out. Or, you have this other issue, which is the foreign exchange issue, which continues to loom large, over everybody, right? It's like coming, I think I've talked about this, some of the DFIs that have invested in private equity funds in Africa have shown how over 10 years, these funds get funded in Forex, they deploy in local currency, in local currency, they're 3x multiple, 4x multiple, but in Forex, they're barely 1x. And, and that really hurts, right? Because at the end of the day, you are going to get measured against your peers, who might be in other countries, right? And don't have the same problem. So, some fund in Zambia, will return 1.4x. And, and that's because, the currency may have been somewhat stable. And then funds in Nigeria that have returned 4 or 5x in Naira, absolutely killed it. They'll be at the very top, top of private equity returns with those types of multiples. Then you return the multiples back into dollars and they don't even make the hurdle. So those are the kinds of issues. So when we're sort of thinking about these things, you're thinking long term, you're thinking long game, and you really have to optimize for risk and return. That's just how you think about it. On the company side, certainly we've seen more and more companies try to domicile themselves in the US. Now, for very specific reasons. One is that a lot of American investors are lazy. They're not interested in trying to go to learn other domiciles. They're just like, yeah, that's great, but let's do this in Delaware, right? So you see that all the time. Now it speeds up your fundraising because, they're very pattern matching driven folks. Like, okay, I did this before and it looked like that, so that was great. So I need you to look like that. But the challenge then becomes, okay, so if you start to actually perform, what happens to your tax exposure, right? And it can get really tricky if you're getting into some of the new areas in fintech. So for instance, like you're in crypto or whatever it is, and someone's saying, well, that's funny because you're not settling domestically, you're settling overseas. You have some back end settlement mechanism that is domiciled in the US, or the IRS says, well, we'll consider that to be domiciled in the US, and so therefore we're going to sit down and impose taxes on you, right? And one of the things I love about the US system is how comfortable they are with extraterritorial jurisdiction. They don't actually care where you are. They just be like, oh, is that where you are? That's great. That's our money. And so you now have to start to think about these things, and it gets very sophisticated for small companies, right? And and the folks that use the advisors that can sort of guide you out of this have a lot more money to protect. So those are the kinds of things that as we sort of work through this, we don't know everything right now, and that's fine. But it is kind of important. I think more and more people should try to figure out how to share some of these learnings right? It's not about sitting and going, we're competing or whatever it is. It is like, listen, what is the best way to do this? Okay, I start off in the UK, then I go to Uganda, then I go to Ghana. All right, so where should I actually re-domicile? Should I domicile in Mauritius, which is expensive and tedious, or do I domicile in Luxembourg? And then, of course, with Brexit, God knows what that means, right? So I think there's a lot of, we get a lot of moving parts. And if there's one thing I think will be useful, maybe to set up, some sort of, to convene some discussion around what people have learned, what they've heard, and share best practices.
Great, great. So our partners, KTN, are here. I'm sure we'll go back and be able to come up with something to help the ecosystem. But from everyone's conversation, one thing I can pull is the Nigerian market still has a bit of work to do around creating the enabling environment, both for the fund managers and the companies. There's a lot of sharing that needs to happen in terms of our learnings and experiences. And then, like Ia said, there's some people that have to remain on the ground to continue to push to ensure that change happens sooner than later. So that's on just having creating the vehicle for investment, right?
Sorry, quick one, Victoria, or even capitalize on what already exists, because having been in this market for a year or two, I think one of the things that I find very funny is that there's a lot of assumptions made about the state of the market, and what the market would let you do. But if you actually go and work with a really good lawyer and actually explore the laws, you'd actually find that there are smart ways around some of these challenges. And it's not necessary, it's a bit of a duct tape approach, but you'll get the same results if you're determined. So for example, you can talk about fund repatriation. We just repatriated $3.7 million to our investors out of a Mauritius setup. But we had some Nigeria exposure. And what we had to do was we actually had to set it up via something called a free trade enterprise within a free trade zone, right? And that actually allowed us to be able to repatriate the Nigerian leg of the transaction accordingly at the end of the investment period. It's a bit messy. The body of work around it is not clear. You know what I mean? And that's where our lawyers have a lot of work to do to actually get everybody to the point where some of these things are better. But I think the opportunity is too big to let up, with AFCFTA coming, with what is sure to be the passporting of financial services, with countries like Rwanda waking up and passing international finance company and enterprise laws. We're going to really see a huge explosion in terms of the sophistication of our ecosystems. And I think it's important that we have people who are interested in tracking it. The US system exists because people innovated around what existed and gradually pushed it to where it is today, right? If we don't do that at home, we can't hope that somebody is just by change. The guys in the legislature don't even know what's going on. I had to go to National Assembly and get them to change the laws and say, well, look, here are examples of banks who've invested in venture capital funds, and banks should be able to do this up to a certain level. And, let's walk through all your issues. So we have to be on the ground to educate. We have no other choice, right? All of us, even those of us domiciled abroad, have to do that work. Otherwise, we shouldn't be hoping for change.
So I'll just watch you. I don't like stress. I'll just watch you. I commend you.
Of what you've said.
Okay.
So we've seen a lot of, you mentioned innovative ways to work from home. I guess that everything has changed. 2020 has made it very clear that things will not be the way it used to. We might get past the pandemic at some point, but things will not be the way they used to. How has this change affected how we think about portfolio selection, how we deploy capital? We know there's still work to be done in terms of the vehicles, but what I've seen is investment must go on. How have we begun to think about the future in light of COVID, in light of AFCTA? Maya, if you can tell me how has that affected your deal selection? Are you still able to review deals remotely?
Yeah. So fortunately, like on the deal selection and diligence side of things, fortunately, because we're writing tickets into like 60% of our portfolio's valuation, total company valuation, is at or under 2.5 million. So we're very early stage investors into companies, including our follow-on investments. Like we've done 30 investments, including follow-on and everything. Like only 2 companies have been over a 10 million valuation. So we're, again, really, really early. And so the core metrics that we're focusing on in the diligence process, we have been able to do and have been doing remotely well before COVID. And that includes, everything from, just the general entity structure to customer surveys, to speaking with former investors, to speaking with current investors, speaking with team members to understand the cohesion and alignment of values and sort of milestones of the company, et cetera, et cetera. And so I would say, interestingly enough, we deployed more capital last year than the last 3 years combined, than 2017, 2018, 2019 combined, because not only were we able to cut out a lot of the fluff, because previously we thought, we'll sit with the founder and, we'll have that gut feeling about the, potential investment worthiness of the opportunity, and understanding you can actually remove a lot of the biases that we have as individuals and just focus on the pure metrics and mechanics of the business. And I think it's actually, now we like 37% of our portfolio companies are female founded or co-founded. And I think that having the removal of bias and just having everyone apply straight through the website, focusing on key metrics, of course, having that FaceTime with the founder via Zoom or however we're engaging these days is an essential part of that. But I think it's only enhanced our ability to focus on what's really important in a business, and like seeing the performance of our portfolio, even in the last, 6 months to 1 year. This has materially positively impacted us as a VC fund. As far as on thinking about sort of our strategy and structure, et cetera, we've realized how important it is to have just general frameworks for how we're thinking about an ecosystem. And for example, instead of before we'd say, we're investing in Nigeria, Kenya, Ghana, blah, 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 these countries, that's it, finish. Understanding the key, how radically the ecosystem has been changing, like even the amount of VC dollars that are coming in since 2016, every year there's been like a 2x in the amount of VC dollars, and how that's materially changed the type of investment opportunities, the liquidity events that are happening. Just even in 2020, the deal sizes and the M&A activity that's happening has really materially changed the VC industry, or the tech industry as we know it, and provided incredible new opportunities. And so understanding that as opposed to having hard and fast rules and places specifically that we're looking, and strategies specifically that we create just outlines and parameters. So now we have, an extended checklist that will allow us to invest in the ecosystem, whether it's like the cost of a gigabyte of data relative to the per capita GDP, or it's the mobile penetration or the internet penetration or the consumer demographics, et cetera, et cetera. So we just have these frameworks which will allow, as the ecosystem continues to radically develop across the continent. Rwanda, Ethiopia just had its telco sector privatized. Like that's going to impact the investment opportunities coming out of East Africa. So instead of having these rules, we just have the framework, which as these other ecosystems evolve, we'll be able to include them in our investment thesis and our strategy as well. And on the other side, when it comes to the actual deals, yes, COVID has materially adjusted our diligence strategy, what we seek out and look for in our investment memos, like, is this a COVID resistant or, pandemic resistant, things that we had never before considered. And even just looking at the volatility of regulation, like having to look at if it's in a financial services sector, if it's in mobility, if it's in logistics, and now increasingly in healthcare, having to consider the volatility of regulation and be able to operate around the sort of opaque nature. And as regulators haven't really figured out how to look at these types of opportunities, having to deal with like the human factor and how we can consider that while investing. And I would say the last thing is now similar to the framework, just being able to look at the GDPs of the countries where we're investing in, and the larger and the fastest growth sectors within GDP, as far as saying, or instead of saying, this and this is specifically where we invest, because understanding what industries, even on a macro level, are recession resistant, and understanding what the pandemic is going to do for capital, for consumer behavior, et cetera, over the next 5 years. We want to have that agility. And then lastly, being able to follow those who have succeeded in the past as kind of just an open, where are the most successful founders in the ecosystem going next? And that's really what we're acutely aware of and paying very close attention to as they pioneer new sectors that I can't predict today where they're going to go next, but I know certainly that will back them.
Interesting. So if I hear you paying attention on the macros, building frameworks to support diligence and screening, and following the footstep of people that have been successful and where they've gone. I think it's very interesting because I know that quite a number of the conversations we've had, most founders or most VCs will say, oh, we've been able to figure out a process. Prior to now, we couldn't figure out a process, which is interesting. But once the deal is done, portfolio management starts. Egosa, can you talk to us about how easy or how difficult it's been managing your portfolio and getting them to where you want them to be in light of the current global situation, the pandemic, after, and all the things that have happened in the last 12 months?
Well, I think if we look back at, we kind of got concerned in February, and I think by March, everybody was sort of like, okay, everybody needs to stop working from home and so on and so forth. So if we sort of look at that as the last 9 months of 2020, I think we saw very different frames. Immediately, everybody sort of, hunkered down and, and tried to figure out different things that, we could do. And one of the things that I think we recognized early in the process was that remote work was not, because we have portfolio companies operating in different parts of the world, remote work was not going to be a trivial process in Nigeria. And it was little things like, I remember we talked about what we could do for the portfolio companies in addition to sort of your traditional portfolio management things. And one of the things we realized was necessary was that we needed to provide support for the companies in sort of different ways. And so, for instance, this is such a Nigerian thing, but we went and bought fuel. We went and bought diesel, for generator, because all of a sudden the things that you'd never think about because you're working in the office, then you come back to your house and then you realize that the generator is only on from 7 p.m. to 7 a.m. and you're working from 8 to 5, and so we're doing things like that, buying mobile data for employees of portfolio companies and the like. But that was just a small contribution from us. But I think overarchingly, the portfolio ended up being somewhat barbelled. There were companies that absolutely took off, and then there were companies that absolutely hit the wall. And then there were companies that kind of stayed with their heads above water, just treading water, hanging in there. Tightened, unnecessary expenses and the like. But, these are startups that probably didn't have a lot of unnecessary expenses to begin with. So, but that changed. Now, what that did for us, though, was sort of realize a few things. I think, we have a almost 40 company portfolio, and it was surprising to discover how nearly pandemic resistant the overall portfolio had ended up being. Now, this was also a lot of how we think about risk across the portfolio and how you diversify risk by exposing to different sectors and different elements inside different sectors. But I think that was the one thing that kind of surprised us, right? That, we had done the work we said we were going to do. And, you can sort of, no battle plan survives first contact with the enemy. And so when the enemy showed up, you kind of realized, how decent the battle plan was. For a lot of the CEOs, there was resilience, right, for the most part. And, we've talked about this, about how, for the African ecosystem in particular, there's so much about anti-fragility, the ability to thrive in disorder or chaos. And, and that, I think, showed up. And so even the ones that kind of hit the wall didn't quit, right? And so they just mapped their way around the wall. And, by the end of Q3, it was crazy. Most of them were back, and, probably even outperforming what we thought they were going to do. So what I think this last year has done, certainly for the African ecosystem, is that we're going to have a crop of tested CEOs, not just the day-to-day grind, swimming upstream type testing that you see, but battle tested in much hardier ways, which I think is great. And I think the other thing is that some sectors have that what you found, I think, as well, was that some of the CEOs got business slowed down enough where they got to pause and become better strategists because you could think rather than just running, right? And and I think everybody benefited from that, and and I hope that some of the benefits from that sort of stretch out over the next couple of years, where you start to see the outcomes of the pause and think mode that people got into last year.
Interesting. So I guess we have barely 10 minutes. We have Q&A. So if you have any questions from the chat, feel free to put it in the Q&A and we'll get to it shortly. So E, the last question comes to you. From what Egosa has said, we've seen that we have resilient founders. We've seen that fund managers are able to build a resilient portfolio that can withstand perhaps a pandemic of this type over a 24-month period, right? So I don't know what it will look like in 36 months. So what would you now say to the outside world about investing strongly in Nigeria? What would you say to traditional asset managers here in Nigeria about investing in tech largely?
Yeah, I mean, looking at it as, the pandemic proving that we have resilient founders is one approach. But I think the other point of view really is that, this is the moment we've all been waiting for. So we shouldn't be so surprised that our founders survived. I mean, this has always been the promise. It's like, look, this digital transformation story is literally for such a time as this, where your entire life is run from screens, you know what I mean, as we are currently engaging right now. So I think, and then when you actually take a good look at the results of the year, and you take a look at how other sectors are performing, I think you come away with a sense of gratitude about, how well we've been able to do versus the rest of the country, and something that shouldn't be lost on us. You know what I mean? But that also imbues a responsibility on us and on capital everywhere to take another look at the sector, but to also take a look at it from a society-wide resilience perspective, right? Which is, if no one invested in the 54 genes, if no one invested in the, in the Zoom, if no one invested in the, if no one invested in the payments companies, how would we actually have been able to fare during the pandemic? How would businesses have been able to survive the pandemic? How would we have been able to get our people tested? How would, so, those of us who do this work, we're not doing it because we're mad people or just because we want to make money. At least I can speak for myself. That's it. It's not because of that. It's because technology companies need to exist to make society more resilient in the face of shocks, right? And in order to enable us to leverage the good powers that science, technology, and innovation have given us to be able to turn some of our country and our continent's biggest challenges into global business opportunities. And so I think really the lesson for fund managers is, I think the conversation I've had with my fund manager colleagues that are more traditional have definitely shifted. There was a tendency to be very dismissive, a little bit very dismissive, very caustic, very what the hell are you doing here? And now, they're happy to take Zoom calls when I say I can't make it to your office. Where before that would have been unforgivable. So I think it's really for them to open their minds and to understand that the world is changing. Even when we're all vaccinated and the pandemic goes away, we would all still live in this world that we're currently living in. And so there's a need for everyone to just open their minds and learn. Even we're learning so much, because when you think about the digital economy, it's not just about software and apps, right? Like we're investing in data centers, we're investing in subsea cables, and understanding at a very deep level all the work that has to go into building out the digital infrastructure, the building, into building out the physical infrastructure that is dependent on that, into building out digital platforms for data that enable everybody to connect, into building out a much smoother set of digital financial services that go beyond payments, but even to ownership and understanding how the capital markets work and all of that. And then understanding, at the end of the day, all of this, our society today boils down to talent, right? What are we going to do with all the talents that we have? What are we going to do with them? Because the world has fundamentally changed, and the way the world sees value has fundamentally changed. So I think that's really where traditional asset managers need to really kind of open their minds and broaden their thinking.
Okay, so asset managers, local high net worth investors, I think the message is open your mind and see a new world. So we'll go into Q&A and just try to wrap this session up quickly. Ia talked about 54 gene. Interestingly, there's a question from Meyer. Ms. Meyer, your fund has invested in 54 gene. How can you address creating funding for proof of concept in project vaccine diagnostics in Nigeria, which is lacking in comparison to the US? So I take that again. How can you address creating funding for proof of concept in project vaccines or diagnostics in Nigeria, which is lacking in comparison to the US? So Maya, that's for you.
So yeah, we did do so I just want to, before I give an answer, preface this with, we did invest in 54 Gene, but we are by no means anything close to a healthcare technology expert fund. We are just starting to explore the space, given the new market opportunity and how important it is, both as a investor regarding the market size or the increasing market size, but as well as the impact that it will have across the continent and continues to have. So just want to preface that. I don't have the answers. I'm not the expert in the health tech. But what we've seen, last year, not only was there a 50% increase globally in the amount of VC dollars going into healthcare technology companies generally, including in across Africa. So in pandemic times, I think investors realize the importance and imperativeness of sort of 0 to 1 technology. Like before 54 Gene, there was no biobanking in Africa. Like they are literally pioneering the entire space. And yeah, I'd like to just, I'm not sure without the pandemic how the focus could have transitioned to healthcare technology as rapidly as it has. But I think definitely innovations that are pertinent to the times and as the markets are transitioning will get the focus of investor attention. As far as proof of concept in the healthcare space generally, that's quite hard. It's quite difficult. We are post-traction investors, but if you are working at a proof of concept, I can say just demonstrating the closest competitors, the total addressable market, your relevant experience in the industry and your background and why you have the core key skill sets to be able to execute whatever it is that you're trying to do. And also there's increasingly DFI, USAID, different global governmental organizations and nonprofits that have dedicated capital for healthcare innovations, particularly in this time period. And there's no shame in getting grant funding or sort of nonprofit capital at the beginning to be able to demonstrate that proof of concept, so then you can get exposure to the VC industries after you have sort of post-traction business.
Cool. I guess we'll take 2 questions and then we'll wrap up this session and go for a break. The second question is, what is being done to provide a framework to funnel the huge capital locked up in unclaimed dividends into these ventures? You're the specialist. So perhaps you take that.
Well, look, I mean, the reality of early stage investing is it's extremely risk prone. So I don't know if unclaimed dividends is kind of our approach, our choice funding source. That feels like robbery. But what I would tell you is that, you know, given where yields are today, at least short-term yields, you know what I mean? There's definitely a lot of desire for long-term innovation despite the risk associated with it, right? And individuals are voting with their feet because the banks aren't giving them the products that they need. And that's why you're seeing this whole buzz around crowdfunding in the agri space, because people feel like, look, you know, I don't just want to invest in Naira swaps or kind of like useless instruments or just, you know, feed a bank's balance sheet while they give me zero return. I actually want to invest in something real, something that can change people's lives. And even though the regulator is a little bit clueless about how to take advantage of that general angst, and a lot of the traditional firms don't really know what they're doing in that respect, I think I see a lot of opportunity, because the average Nigerian, if you actually talk to them, over 33% of them are going into alternative investments already, but without the guidance that we need. We don't have a very well-developed investment advisory class, right? Like if you wanted investment advice today, where would you go, right? It's not an easy question to answer because all the traditional guys are just railroading you into poorly performing products that give you 5% yield when inflation is 11%. It doesn't really make sense. You're already underwater before you even started. So I hope that, you know, certain changes are forced over the next 2 to 3 years that basically ensure that you have younger, more dynamic managers starting out on their own and being able to better advise people on asset allocation. That's the preferred path. I'm not interested in robbing people who have unclaimed dividends. That we'll leave that to the politicians. But that's not what we do.
We leave that. Got it. So we'll take one last question. And how do we ensure more local startup founders versus expats get funded and become role models for local future generation of entrepreneurs? Agusa? So how do we put the local startup founders versus expats? How do we give them more funding and set them up as role models for the future?
So I'm going to throw something out here because the faster I think people realize this, the better it is for founders. But one of the measures by which investors like to judge founders is on their, how would I murder their raisability. In other words, their ability to raise money. And it's less about, you know, this, you know, it's really, you know, because the way venture works is, you know, and it's also a challenge because in many ways it kind of punishes investments in folks who don't necessarily have these qualities. But the way venture works is if I give you money today at a certain valuation, right, in 18 months, this in the US, I'm expecting 2 to 3x step up from there. And so what I'm trying to do when I'm coming in early is to figure out who's going to do the next round for what price and what do they like to invest in. So what you then run into is you now detect the pattern matches that exist further downstream. And then you try to fit the founders you're investing earlier on into those patterns, right? And what you find is that the expat founders, you know, because they come with the networks, they come with the connections, they come with, you know, the look and feel, you know, and they come with a pattern, right, tend to be more appealing. And so, I did this podcast a week ago, I think, on Disrupt Africa. They were asking me about one of our portfolio companies, Grow Intelligence. We just announced this huge Series B raise. I think it's the biggest by a female founder, a Black female founder. And I talked about one of the challenges in, when you're going out as a Black founder, right? So, she had raised all this money, she had all of this traction, and, and people will have some levels of incredulity. And, we always used to talk about it as an African founder or a Black founder, you can't, there's no tell in this show and tell. It is show. Right. And so what you find is for local founders to counter legislate the existing narrative, right, they had to be focused on the show, which means that if you're going to be able to raise a little bit of money, you're going to have to outperform the energy that comes out of that money. I mean, you are going to have to triple, quadruple it, because you're going to run into it. We've seen it in our portfolio. Company shows up, tells us they're 12 pre, right? The valuation is 12 pre, $12,000 in revenues. Okay, that's interesting. I mean, I'm happy for you. Local founder shows up, $800,000 in revenues. Someone says, "Oh, we'll give you, $2 million." Right, and it's one of those challenges that I think we'll have to face, because at the end of the day, you really have to measure for outcomes. But the truth, the secret is people are measuring you for your raisability. And it's unfortunate, because then what that means is that people who are not, and by the way, we find that women are disproportionately, they bear the burden of this, because they're not, as a whole, and I'm not generalizing, I'm just saying sort of based on sort of what we've seen, they're not the greatest storytellers. Right, so they don't create stuff out of thin air, right?
Oh, do tell.
Vaporware and all of that good stuff. So what you then find consistently is that they've got, you have to sort of make those adjustments and balance that out. And unfortunately, they get hit. The market gets hit. I mean, I think we see this all the time, and eventually, I think, one of the reasons why I said, with Grow Intelligence this round, we've got another one coming up, another one after that. It's until you sit down and show these folks that say, listen, we can build not $1 billion businesses, because no one cares about that anymore. We can build 10, 50, 100, right? Despite you making us swim upstream every step of the way, right? Until you do that, then these local founders, you don't walk into a room, trying to fight yourself to zero. You're coming and they're giving you the credit because they're like, okay, fine. So you change the pattern, and that just takes time. It takes 5 years, it takes 10 years. And, and I think that patience to be able to build that continuum of outcomes, of positive outcomes, is something that a lot more people sort of have to pick up.
Patience to build that continuum of outcomes. So I guess what you mentioned will take me back to one more question. I was going to close this out, but one more question for Maya, and it's really around female founders. Maya, will you please expound on how you went about achieving almost 40% women-led ventures in your portfolio, and what challenges you faced getting there? So
yes, I would happily. And they were all great storytellers. And I would like to believe myself a great storyteller as well. Thank you very much. So fortunately with our fund, like what we're optimizing for as far as where we can add value to our portfolio companies is specifically around giving them access to later stage capital. So we invest in them. 80% of our limited partners run later stage investment vehicles. If they're not the greatest fundraiser, that's really where we can help. We can help syndicate, we can help raise for them, we can give them access to capital. And then secondly, access to Pan-African business relationships, because the other 20% of our investors run various industries across Africa, from telecommunications, banking, energy, et cetera, et cetera. So we can help them across the continent with our limited partners, and we can also help them get access to major contracts or distribution, et cetera, et cetera. So what we optimize for in the companies, and maybe this is part of it, what we optimize for is not necessarily the best fundraiser, but the person who has the most integrity, the person who's the most humble, the person who demonstrates that they have an empathy and an ability to pay very acute attention to their customer and build something that they need. And so these are small things that we optimize for and are really a core part of our diligence. And maybe that's part of why we have, 40%, almost 40% female co-founders and founders that we've invested in as far as our portfolio. And also because it happens to be that when you look like the people that you're investing in, it's easier to find them. So by having, we have 64% of our team is female, and our executive team, and it happens to be that we're women. So we are around women. And then by that nature, then we see more deal flow from women. And I think that it's just a testament to how imperative it is when you are hoping to have a diverse portfolio. And also there's infinite statistics that demonstrate that diversity and having at least one female executive on the team of the startup literally materially impacts positively the IRR and the performance of the companies, like materially. And so as having that as part of the investment strategy to lead to higher returns for our investors, our limited partners, as well as just the importance of having diverse people that we're backing and ensuring that everyone has equal access to build the next generation of billion-dollar businesses. So in conclusion, I think everyone's great storytellers, and we're optimizing for people who can pay acute attention to customers' needs and build things that people want.
Cool.
But I will throw that makes those who have done this rare. It makes the investors who do this consistently very rare. In fact, you see these are more unicorns, the investors that do this consistently, that are able to sort of elicit the best out of women founders, can sort of guide them, can do this. They don't show up very often, this type of investors, right? And you can see it in the numbers, which is the interesting problem. When the Me Too thing happened in the US, you could see some tailwind that came out of that with this, ecosystem shifting and sort of women getting, more attention, more investor attention, more investor dollar attention. And that was great. And then the following year, it dipped. When it was like, oh, okay, so that story is over, that hashtag is over. Great, let's go back to default, right? And so it dipped. So it's still a problem, right? And the question then becomes, what is the root cause of the problem? Is it because the patterns are not matching, right? And what we say is, these guys, who are mostly guys in venture, there's a very herd-like mentality. And if you show them that there's a path from woman to multi-billion-dollar returns, the behavior will change. That's just how it works, right? And so trying to fix some of these things early on, recognizing some of the challenges that you're going to have a hypothesis as to why you don't have, like we constantly do it as well. We're roughly about 35% women in our portfolio as well. What is that, right? And then how do you fix it, right? And so you can sit down and say, you know what, hey, I'm going to go get money, I'm going to go do this, I'm going to do that. But here's the funny thing. Even if you were able to tell the story on behalf of a founder and you're able to raise money, right? If you have not shifted the mentality of the investors you bring in, right, then they don't get the same benefits of the doubt along the way. Then you now start, something small that some dude who doesn't know what is left from right as a CEO gets a pass on. The woman founder sort of has to go sit down and be fighting fires all the time. So there are long run, first, second, and third order effects on this, right? So it is really trying to fix this at source, identifying what types of causes may be generating these outcomes, and then saying, hey, listen, how do we do this better, right? So it is a tough thing. And one of the good things I like is that there are more LPs that are trying to push for more gender funds, and that's good. So we'll see whether, again, because the measures of success in everything we do in this world you don't see it in 6 months. You don't see it in 12 months. it is sort of 3 to 5 to 8 to 10 years, right? So as we see some of this stuff now, it's going to take a while to sort of see the actual outcomes. But, I think talking about this more often, sharing the key insights into what, we've seen, and hoping that people can sort of realize that at the end of the day, there's a ton of money that can be made, because that's what a lot of people are trying to do here. A ton of money that can be made by expanding the aperture, right? That's the key message I think we should all go away with.
Thank you. Thank you, Egusa. Thank you, E. Thank you, Meyer. As we mentioned, most of the conversations we'll be having in the second session will be from some of the information we'll be able to synthesize. We'll talk more about how governance can actually influence selection, such that focus towards channeling funding to female-led organizations can either increase or decrease, or even having leadership on the team. We'll also focus on issues with enabling environment and how the work that early stage founders do is critical to creating a pipeline or even a foundation for later stage founders. Thank you for your time and the insights. We really do appreciate it. To those who are watching, we'll just take a 5-minute break and then we'll be back with the next session. Thank you, everyone. If you're just joining us, we just finished the first session of the KTN Global Exchange Fireside Chats, where we had a conversation with early stage investors around the development of the technology ecosystem. It was a very interesting conversation, and we're taking to the second session. The second session, I have 2 seasoned investors who have experience investing across Africa, and they'll be helping us synthesize some of the views and feedback we got from the first session, as well as providing insight into some of the trends we've seen in later stage investing across in Nigeria, but also generally across Africa. With me, I have Labi Williams. He's a partner, a managing director at Kuramo Capital. He's built a formidable track record investing in debt and equity across several sectors, and he sits on the board of multiple companies. I also have with me Aniko. Aniko has over 20 years of experience investing in emerging markets, of which 18 have been focused on technology, media, and telecoms. She's the founding partner of Atlantica Ventures, an African impact-focused venture capital headquartered in Nigeria. Thank you for joining the chat, Labi and Aniko. It's good to have you.
My pleasure. Thank you for having us.
Thank you, Victoria.
So, sure. So we'll jump right into it. The first session was very interesting because several topics came up. We had conversations around the macros here in Nigeria and how they influenced venture investing. We had conversations about female-led organization and how difficult or perhaps easy it's become over the last couple of years to access funding, even though some sort of gap still exists. We also talked about investment vehicles and perhaps the enabling environment of the work that needs to happen here in Nigeria to allow us to see more fund managers begin to domicile here in Nigeria. I guess just building off that conversation, I wanted to know what your thoughts are. Around female-led founders, providing funding to female-led organization in light of governance, right? There's a lot of talk around ESG. There's a lot of work around ESG. How do you think that is going to change some of the trends we've seen with respect to perhaps gender-led investing? Aniko?
Okay, well, thank you very much for having me here. So there's seems to be a lot of noise, I would say, around investing in female entrepreneurs, whether it's into tech companies or founders of funds. But I think it's sort of early stages of development. I think the noise is bigger than the action. Now, as the previous panel members have mentioned, there are lots of studies proving the benefit of having a balanced team, whether, again, it's at the startup level or a fund level, in having better outcomes. Same very much stands for boards of companies. I think you need about 30% or so of the board to be female for it to actually be a shift in thinking and interaction. So if you are the one female board member, which is oftentimes me, has been for many years on the board, it may or may not be enough. So it's good to see there's focused attention on it, but I think it's a relatively long road. And as I recently wrote about it on LinkedIn, it's on us, especially as female senior investment professionals, to help push this agenda even further than it would be going on its own. So in our case, our fund is 70% female, and looking also to invest in female entrepreneurs, in addition to obviously supporting and investing in the entire ecosystem in the VC space in Africa.
Interesting. So you'd mentioned now we're beginning to see a lot more women take on board roles, right? Labi, in your experience, right, with investing, is there a way to, in terms of the metrics you get, or in terms of the results, is there a way you've been able to generally perceive the difference between a fully male dominated board vis-a-vis female, a mix between male and female type board setup? Have you been able to tell? Can you tell the difference?
That's a great question, Victoria. And thank you to KTN for having me on this session. I must say it's not something we've set out to do, in sort of a research manner as such. But indeed, I have served on multiple mix of boards, and there are some situations I've been in where it's been, I think, male only, and I suspect we may have had better outcomes, or at least enhanced our perspective and our achievements with more diversity. Definitely, I think from our perspective at Kuramo, we definitely are very focused on gender. You look at our team, and close to half of our team, spread across our offices are women. So we think that's definitely extremely important. And as we further diversify, our offering, we're also spending a lot of time looking at potential specific women-focused funds and making progress in that arena also. But we have backed women funds in our current line of work, and are at least pleased with our results, and it's something we continue to focus on.
Okay. But so still in governance, right? How outside outside the portfolio companies that you've decided to deploy funding to, just from an ecosystem perspective, do you still envisage that there's a huge gap in terms of support that goes towards helping female-led companies get access funding? Do you think, Aniko had mentioned, there's still, with early stage investing, there's still a lot of talk and no action. When it comes to later stage investing, what's your experience? Do you think more female-led founders are accessing finance, or is there still a huge divide?
There's definitely a divide, but I think it's being closed. I think it's actively being closed, and we see more transactions happening. I mean, you speak on the later stage side, there was, I mean, just, there's at least here from on the Nigeria side, there was a recent transaction in the pharmacy retail space back in the female entrepreneur. So, I think, I mean, that's just a one-off example, but there are more examples we're seeing. And, I also do some technology or early stage investing, which I've been doing for about about a decade in a personal capacity, and I've backed female-led businesses also. So I think, I mean, it's as much the opportunity, the entrepreneur, their capabilities, and also how you can help them and add value. And wherever that's the case, I think you can do pretty interesting things.
Interesting. Aniko, what are your thoughts around that? And the later stage female led organizations accessing more financing?
Well, in my previous job, I used to run the technology, media, and telecoms group globally at IFC. So I'm mostly invested in the telecom and tech space, and that's also very male-driven industry. So I did not really have the chance to support female entrepreneurs. So what I was looking to do, though, as our investee companies would attest to it, is to encourage them to create gender balance within the organizations once we made the investments. And one important point I would like to make is that it's not enough that it's, let's say, 50-50, or we aim to be 50-50 in the gender balance in general. It should actually really be at every level of the organization, because what I've seen across the board is you'll have at the bottom good representation and sometimes over-representation of women on a percentage basis. But as you go up higher up on the organization, there tends to be a big gap. And then on the top, sometimes it tries to get plugged, that gap, and then you will see women again, but in between, not a lot because of I guess the enabling environment within those institutions that doesn't really support necessarily women as they go through, having children and the like, and getting additional responsibilities. So it's really important that it happens in every level. I think that's when you have a really well-functioning organization. So that's what I tried to achieve once we made the investments.
Diversity across different levels within an organization. Out of the first session, we also realized that in setting up investment vehicles, some of the issues that the fund managers had was with exit, right? And so we don't have deep enough capital markets, in their opinion, or perhaps so, that allows these companies be able to list. So they're looking for more mature markets where they can exit. The truth of the matter is, it's not the early stage investors that are driving this process, it's the later stage investors. So how are later stage investors working with the capital markets, with the exchanges here in Nigeria, to be able to perhaps build a solid foundation that can allow later stage technology or even SMEs become listed here in Nigeria? Labi, can you speak to that?
Sure. In terms of the capital markets, I know you used the phrase deep enough. And I mean, there's space for the capital markets to continue to develop, but I think they are deep. I mean, if we look at in Nigeria, you had MTN listed in Nigeria, which was a seminal event. Airtel has listed, Bua Cement has listed. I believe Bua may be the third or fourth largest company on the exchange now. So we do have deep capital markets, and each additional listing further deepens the markets and widens the investor base, I would say. We've also heard about a large payments fintech business that has considered a listing and may still eventually list. So I think the markets continue to open up. I know that there are some restrictions, for pension funds to make some investments. You need to have paid a certain level of dividends or profitability every year or for about 3 or 5 years or so. So that sometimes may restrict some startups, but some of those regulations themselves are also to help, you know, if you have successes, then more people come. But if you then come into a business that may not yet be profitable or be for a while, and people lose faith, then it actually becomes harder to get what you wish if you rush it too early. So I think, you know, with this levels of activity we've seen, I mean, I know the capital markets were quiet for a number of years, but again, with these recent examples I've given, I think we're seeing a good resurgence, you know, talk less of the strong surge we saw at the last quarter of the year, which I think made Nigeria be one of the best performing in the world for the year, just primarily on the strong fourth quarter we had. So I think we'll continue to see this, definitely.
Okay, I agree with you, but there's still a perception within the innovation ecosystem. If I need to list, I need to do it outside the Nigerian jurisdiction to be able to get some sort of value that allows my later stage investors who put in quite a healthy sum of dollars have their upside. So what kind of work needs to go in over the next couple of years in partnership with the exchange of capital market professional to ensure that this perception shift changes? That's one. And secondly, from your own perspective, do you see some of the companies that you're currently invested in begin to say, we're ready to go to market and we will do it here in Nigeria?
So yes. So one, on the companies themselves that look to the foreign markets, again, I mean, some of those markets have a longer history of taking earlier stage companies public. But at the same time, and there's detailed reports around this, you know, if you look at markets like the AIM market in the UK, where a number have listed, most have not performed well. You know, so if you have that here, you're going to actually shoot yourself in the foot. You know, you're going to try and advance it, but you're going to end up setting yourself back potentially. Now, you know, I can't speak for the NSE, but I know they're definitely looking for more ways to do this. You know, they've had a partnership between the NSE and the London Stock Exchange for a couple of years, highlighting, you know, interesting, well-performing companies that could look to list on either market or on some market at some stage. So those efforts, again, I say, are, you know, continue to be underway to keep moving closer to getting more of these potential companies listing. You know, you also asked about my portfolio and you know, potential listings. It's definitely something we consider, and I think, you know, sometimes also there are steps to a listing. And I can talk about that from having, as you said, you know, I've worked both across equity and debt. And you'll sometimes see, you know, companies looking to go onto the public markets because it requires a lot of transparency, costs, high quality audits, you know, legal representation and the like. Usually you'll see some firms take a step by going to the bond markets first and raising a corporate bond. You know, you get a little more exposure, used to that investor base before you subsequently list. And we have companies that have taken similar steps. You know, so I think, again, there's also sometimes a path, and we're on that journey in a couple of instances.
Maybe if I can tag on to Labi's comments, I think it's very true what he has said. I fully agree. And if I look at my 20 plus years of investing across emerging markets and 17 plus in Africa, you don't see a whole lot of IPOs as an exit for companies and investors. And I think it's probably going to pick up pace in the technology space and with startups. You'll see more of that, but I would say the likely exit for investors of startups will, I think for the foreseeable future, will be selling to either a private equity firm or selling to a strategic investor. And whether you IPO or sell to a private equity firm, doesn't matter. You actually have to mature not just in terms of your business and revenues and your path and strategy, but also corporatize yourself. And as Labi said, it takes a lot. You have to have your house in order. You have to have your accounts, legal, you know, your risk profile. well done in order to be able to attract those investors. So I would say IPOs are great, but the bar is high for IPOs, especially on big stock exchanges. I've gone through with one of my investee companies. It's not nothing to go through that as a company. You really have to be ready, otherwise the consequences could be really detrimental. You're not getting what you're hoping to. But really also underline that it's the most likely buyers will be the private equity firms and strategic investors. And if I look at the startup space, and I invested also very heavily in Latin America in my previous job, and that's about 5, 6, 7 years ahead of Africa in the startup ecosystem. And you're starting to see some IPOs from there, but it's mostly from the largest market, Brazil, but it's still very few, and the ecosystem yet is so much more developed than in Africa. I think Africa will catch up, hopefully, and we're here to support that. But I want to caution entrepreneurs not to put it into their head that they're only successful if they did an IPO. They can be incredibly successful having sold to other investors.
So just on the back of what you've said, so secondaries is what we'll continue to see in the market. What kind of advice would you give to very early stage investors around ESG? What are the things they need to put in place that would allow them be well positioned to either exit to later stage investors or even attract capital to these companies they've invested in?
Yeah, so that's one of the things we work with our startups with, to start paying attention to it from the beginning. And obviously, if you're a pre-seed and seed startup, how you tackle that versus your series A, B, or C is very different. It has to grow over time. You cannot overwhelm a startup that doesn't have in-house staff for certain functions to actually do this properly. But how a established company would do, but from day one, start paying attention of building up those capabilities, at least having basic policies, ESG policies and corporate governance policies in place, and then making sure that the path is proportional to the growth of the business. It's really important because even in the VC space, you don't especially in Africa. I think other markets are slightly different, but in Africa, it's mostly impact investors, whether you're looking at it at the VC space and definitely also in the PE space. So getting yourself ready for that, it increases your value and your likelihood of fundraising success. But one more point I would actually like to add on, which I think is as important, if not more, is on valuations. And this is one of the things I always hammer at with our entrepreneurs is, I know there's a tendency to get the next highest and highest and highest and highest valuation as the rounds go on, but you have to be very careful how high you shoot, because once it comes from switching from VC to PE, investors, you may not be able to get the next high valuation. And you have to keep that in mind as to how a PE investor may think about the business, the growth of the business, the multiples they're willing to pay. And you don't want to get yourself in a situation, I've seen one too many companies who set high valuation at the beginning, sounds great, and then the next investor won't come in unless it's a down round. And it usually happens at the larger kind of growth investor stage. So obviously everybody wants increasing valuations, but it has to be in the backdrop of, it has to work along the value chain for you as an entrepreneur to be successful. Yeah. Labi, I would love to get your views on that too.
Yeah, no, look, thanks, Aniko. I mean, I was literally chomping at the bit to come in to agree with you here. And, you know, I really love to see, you know, entrepreneurs, you know, some young, maybe some a little older, but raising capital, driving their businesses. But, you know, I have indeed seen, you know, quite a few, you know, entrepreneurs sometimes really get carried away with, you know, raising capital and spending capital sometimes with, just little to show for it. And, it almost sometimes can be, you raise 100%, you literally waste 50%, but you tack it on to your pre-money, to your capital raise, post-money, jack it up and say, let's do this again. And, I don't know, it makes my head spin sometimes. So I think, it's something to be very watchful for as entrepreneurs, that actually there are metrics to track spending and actually achieve the goals that are being set out for these businesses as they go. To also address Victoria's questions more widely around ESG. With ESG, environmental, social, governance, we know it's all the rage these days, but these are things that have been, I think very close to me early in my career. Aniko, of course, at the IFC. I worked for Actis, which came out of CDC. And so these things have been very important historically and deeply ingrained. On the environmental side, there are a lot of standards pretty similar, from the World Bank, IFC, national environmental protection agencies, ISO certifications, that are all things companies can look to be within and moving towards as part of their advancement and compliance on the environmental journey. From a social perspective, a lot of that tends to be more labor related, as well as, the surrounding communities that are not being disproportionately affected, or that they are actually some allowance is being made to take care of them if they're being disrupted or displaced by potential company activity. And again, there are a lot of specialists, including some of these names I've mentioned, who can help work through some of those issues and, social issues with labor, not using child labor, and, having some balance with, we spent a lot of time also on gender also. And then, of course, governance, which I guess is also part of the key topic around our discussion here. And on the governance side, there are a couple of things. I think it's really a lot, again, around reporting, transparency, but we could spend more time as we go.
Interesting. It's good to hear, because what I'm hearing is early stage investors have quite some work to do. You need to be able to guide the founders so they are not just looking for high valuations as they go. So perhaps helping sense check the numbers they're putting out, or even pump the brakes where required. You also need to help them walk around perhaps a very basic ESG policy in line with where they are at every given point in time. What applies to pre-seed, seed might not apply to Series A. And so early stage investors have a role to play in providing that kind of support. If those supports are lacking, then the chances that they are well positioned for later investors to come in are very slim. So basically what I'm hearing is it impacts the investment horizon for companies here in Nigeria. What are your thoughts around investment horizon? How have you seen that evolve, particularly here in Nigeria, but across Africa? What are your thoughts around it? Aniko?
I would say in the startup space, it's a little bit early to tell as to what's really going to happen, because the ecosystem is so young. Last year was the year when you really actually started to see some M&A transactions taking place. Obviously, Nigeria, the most well-known was SpaceX acquisition by Stripe, and that was in a 4-year period. I probably would say I would be surprised to see a whole lot of that happening in such a short time period. That said, I think you could start, depending on when you entered as an investor and even as an entrepreneur, as over time you might want to cash in a little bit. As the private equity or growth equity investors come in, you can start selling through secondaries. Now, as to when your business might sell fully, if you look at the PE space, PE investors tend to hold their assets for a very, very long time period in Africa. Because the exits are not so easy. Liquidity is not necessarily around, as we talked about, in terms of IPOs and the like. I think the VC space is more favorable to entrepreneurs and investors because there's a natural exit path to selling to private equity firms and strategics. So I would expect actually that time horizon hopefully to shrink a little bit. But honestly, who knows? We're so at an early stage. This is my theory of looking at this space for the last 5 years or so, but I think it's still to be seen.
Interesting. Labi, any thoughts?
Yeah, I mean, on exits, I'd say, traditionally in Africa, PE, you're looking to hold for about 4 or 5 years. I'd say one tends to see that be more 6, 7. And I think sometimes a combination of macro factors as well as particular company issues, and sometimes they come together at the same time. So that slows down the exit process. But at the same time, I think there's also just approach to the market also by some of the investors. And I think, investors need to take a more pragmatic, decisive, action-oriented approach to making these exits versus, I think in some cases there's a little more deliberation and, a lot of almost analysis paralysis and boiling the ocean, trying to go to every potential buyer out there and hear what they have to say in their time. So, I think that those things taken together sometimes stretch these exits. And the buyer you want is not always there. So sometimes when you see the buyer you want, you probably should sit down and take them seriously.
So if I hear you, we still need more private equity / later stage VC investors on the continent. We don't have enough that would allow this pipeline that is already growing exit to them, if that's what I'm hearing.
No. So we have there's a lot of dry private equity powder to invest in venture-backed businesses. I'm just making a point on the back end for the private equity firms. After they've made the investments, they sometimes hold for a bit longer, either due to a company issue or a macro specific issue. But in terms of interest and capital to make investments into businesses that have been held by early stage and VC investors, there is capital and interest.
Interesting. Aniko, any thoughts?
Yeah, that's exactly, that's what I was the point I was trying to make earlier. I think for startups and VC investors, I think it's a very, potentially in my view, is a very different universe than for a PE investor. For PE investor to exit based on what Labi explained, what the obstacles are. My theory, to be proven, is that it's going to be much easier for startups and VC investors to exit because there's so much dry powder, as Labi said, in the PE space in Africa, looking for good opportunities, looking for good deals, companies that are easy to scale. It's much easier to scale a tech company across borders to other regions than your traditional business. And I think you will see the private equity firms stepping into this space and buying these companies.
Interesting. So as we begin to see private equity firms,
Yeah, no, I mean, definitely, there've been a number of successes already. And, again, in this business, nothing, when there's success, everybody wants to replicate. So you'll look at, if we put them out there as a case study, Helios investors, who early on a decade ago came into InterSwitch, subsequently went into Fawry in Egypt. I believe they may have another investment in Egypt and have done something else in the payment space. And those, they seem to have be doing okay there. And, from some of the stories on, Paystack And I mean, you spoke about Paystack and the exit, and Aniko touched on that also. We must also remember, Stripe was an early investor in Paystack, which, kind of makes it a little easier because you know them, you've been in there, and you can make a call at some point to make a fuller acquisition. But I think, I mean, the private equity has also, been involved in technology as direct investors into GSMs early across Africa and done well. Not just GSM networks, CDMA networks, mobile networks, fiber, telecom towers, but yeah, Aniko knows a lot more about this, but that track record of technology investing is there, and this is now a sort of different segment, or an expanded segment of the technology space that investors are looking at, including PE players.
Interesting. So still sticking with return expectation, perhaps Aniko, if you can help us, he's mentioned Helios has focused on perhaps 3 or 4 deals, right? High profile deals. But we know that now more than ever, there's an emergence of a lot of technology companies outside fintech. We're seeing more health tech companies. We're seeing more companies around consumer internet, some even building hardware devices, right? Still sticking with return expectations, do you envisage that more private equity firms will come in, perhaps at the growth stage, to be able to work with these companies to build something, perhaps in line with their return expectations, or just generally to further deepen the technology ecosystem? What are your thoughts?
Well, I certainly hope so. I mean, private equity firms invest across all of the economy, really. So to me, it makes sense that they will then invest in tech companies that try to take advantage of the inefficiencies of those sectors, or disrupt those sectors, or be complementary to those sectors. So I would expect them to support and invest in startups across the board. Now, will the return expectations be the same? I would probably say not. It depends on what's the business model, how easy it is to scale it, how easy it is at the PE stage. You're really looking at cash generation. Is it a cash generative business? And now and in the future, all of those things will inform PE's decision as to, what sort of multiple they might be willing to pay. And then you're going to start switching from, at the VC space, you look at revenue at best if you're doing pre-seed or seed, not even that, in setting valuations, really. But as you get to the PE space, it switches to EBITDA and cash gen, and that's really important. And as you think as an entrepreneur that your likely exit is to PEs, you need to build your businesses in that way to maximize the chances of raising funding from those firms.
Interesting. So if you hold that thought, I'll come back to you, Labi. We won't be taking any questions for this session. We'll just have this engagement. I want to say thank you to Labi and Aniko for joining the session. I hope that some of the conversations that we've had have been very insightful and has helped. If you have any questions that you want to ask directly to either Aniko and Labi, feel free to send it in and we will share with them after the session, and we will revert to you. So thank you very much for joining the session. Labi, any last comments before we go?
Yes, so I think in terms, just from a general, to touch on your return expectation question a bit more, VCs can make many investments and hope a number will do 10x, 20x, and many will fail, but if you will do those numbers. Private equity probably look for a more consistent, about 3 times across the portfolio. So by definition, the characteristics of those investments would look slightly different.
Okay.
You know, so those are the things one has to take into consideration as you look at the return expectations. But just to bring us on the governance side, you know, in closing, I just think, you know, it's important that companies, you know, they're putting together monthly reports, you know, getting audited financials on time, holding board meetings, you know, engaging with the shareholders in an active manner. And as I said, you know, I also make some small personal investments, and I've done this across countries. And you see differences in, you know, Nigeria versus, you know, outside Nigeria, or sometimes outside Africa, you know, where, you know, before you blink, you're being hit with monthly reports, and in other instances, you're begging or hoping, or just you'll see what comes when it comes. And I think that's just so important, because again, to the point made on raisability, you know, sure, it may be look and feel, but you know, just doing the work and having that governance in place, you know, it helps you raise more, it builds more exit interest, it helps your shareholders be your evangelists, and it all just, I think, comes together better. And we're seeing, you know, a number of companies also making good strides there, private companies being quite public with some of their performance and numbers, you know, in the tech space across Africa.
Thank you. Thank you for that. Thank you for that feedback. Thank you, Aniko. Thank you, Labi, for your time. We do appreciate it. We look forward to having more engagement and how we can perhaps develop the later stage portion of investing, particularly in technology and in innovation ecosystem. Thank you to everyone who have participated in the 2 strands of fireside chats we've had today. We look forward to keep the conversations going together alongside our partners, KTN. And thank you for joining the session. We'll bring it to a close now. Much appreciated.